And that'll conclude today's trading activity on this Wednesday, or hump day, whatever you're calling it in your neck of the woods. Call it an up day. The Dow Jones Industrial Average closes higher by about 1.5%, a little bit more than that. 519 points to the upside there. S&P 500, that too ends the day in positive territory by 2.25%, 96 points in the green. And then additionally, the tech-heavy NASDAQ, that closed higher on today's activity to the tune of 3.8%, or 3.75%, however you want to round that off. Huge day for the NASDAQ, 487 points to the upside there. Of course, we're going to have our markets panel for some broader context on this. We did see 9 out of 11 S&P 500 sectors close in positive territory. All right, since I mentioned the markets panel, let's bring him back in. Brad Smith here with Rochelle Akufo and Dave Briggs. And joining us now, we've got John McClain, Portfolio Manager of Brandywine Global, as well as Rob Haworth, who is the U.S. Bank Wealth Mgmt Sr investment strategist. Okay, so the big news here on the day, of course, was the Fed's announcement, of course, widely telegraphed as well, 25 basis points expected coming into this, but perhaps it was more about the signaling. Rob, I would love to get your take on what the Fed said that stuck out to you about where they're signaling for the rest of the year to move from this point.
Yeah, I think it was important that the Federal Reserve dot plot really reflected where the market already is with rate hike expectations, 7 total this year. So that's bringing the Fed in line with the market, not much more for the market to price there. I think the other key thing that we were looking at was the downgrading growth expectations. So the Federal Reserve taking down that the real economic growth expectations from over 4 to 2.8% in 2022. I think that's some of what we're seeing is some concerns that there's a faltering in the growth story here, even though we've got much higher inflation expectations as well. And then the last thing that was key for us was that they're clearly very open to starting the runoff of their balance sheet or the quantitative tightening program, perhaps making an announcement as early as their May meeting. So the Fed appears very ready to battle inflation and do it with all the tools they have at their disposal.
So, John, now that we do finally have this 25 basis point announcement, what do investors care about now that they have that under their belt?
Yeah, it wasn't about the first hike. It's really about the dot plot. And, you've got 5 members now of the committee above 3% for 2023. And as Rob mentioned, we really didn't get a lot of information on balance sheet contraction here and what's going to happen with quantitative tightening on a go-forward basis. And it's clear the Fed's chasing inflation, and we do have to worry, I think, a little bit about stagflation because as I read the minutes, the presser's very hawkish. So we're going to need to get more data. The Fed's going to be data dependent, but it's now what happens in May? Do we see balance sheet roll off, and how aggressive is the Fed going to be with this? Because they certainly don't seem concerned about interest rate volatility or any of the recent declines in financial assets. And, as market participants, we're used to the central banks coming in and suppressing volatility, but that's not going to be the case for the foreseeable future. So we need to buckle up and understand that enhanced volatility and risk assets and interest rates are going to be here as we're unwinding unprecedented monetary stimulus with a number of exogenous factors like the ongoing war and rampant inflation.
John, how quickly will the Fed move slow demand and bring down inflation?
Well, I think we're seeing it, in terms of the GDP expectations coming down from 4 to 2.8%. So I think we're already starting to see this, and, it's certainly a concern of mine.
Rob, we do know that the Fed is looking at some of the progress that they're making. They're saying excellent progress on parameters to shrink their balance sheet as soon as the next meeting in May. What kind of impact do you believe that will have on where the markets are anticipating for the Fed roll-off to not only take place in size and scale, but in how quickly it takes place as well?
Yeah. So, we're thinking, it could be $50 to $80 billion a month as we move forward. I think the important thing we're really watching for that is what happens to the shape of the yield curve. So, as I think was pointed out earlier in the data segment, we now have the difference between the 10-year Treasury yield and the 2-year Treasury yield somewhere around 24 basis points. down from over 150 a year ago. So there's some significant growth concerns being baked into that bond market. And I think kind of the sooner the Federal Reserve gets to that balance sheet runoff, I think the hope there is that helps the yield curve stay positive. Because I think that's where the Federal Reserve will struggle to maintain their path of rate increases, is if they start inverting that yield curve, which sends a sign of fairly tight financial conditions if we get there. But I think that's what's going to, I think, spur them on to get to that quantitative tightening program.
And John, as we talk about the trends that you're seeing across fixed income instruments, what are some of the risks you're keeping an eye on?
Well, the biggest risk in fixed income right now is liquidity, and liquidity in the markets has been fairly challenged, and there hasn't been a place to hide in fixed income to start the year. You've got treasuries meaningfully higher, so your traditional ag products are doing quite poorly. Emerging markets has been challenged, and high yield has been as well. And so end investors have been pulling capital out of this market at a pretty accelerated clip. So for me, it's really watching liquidity in the market. Do we see bid-ask spreads widen out across a number of different products? Do we see dealers step back from the market like they did in 2020? So I think this is something the Fed really needs to pay attention to, is the liquidity, underlying liquidity in fixed income markets.
Rob, the Fed chair talked about the invasion of Russia and Ukraine, and said the implications on the U.S. economy are highly uncertain. If there is de-escalation in the months ahead, could it cause the Fed to increase the speed of their rate hikes, perhaps 50 basis points at the next meeting?
Well, I mean, the interesting thing about de-escalation is it could bring, a faster end to the inflation we've seen in food and energy prices, right? And that really helps the Federal Reserve with their program. If we get that food and energy inflation out there, and we're just dealing with those core price pressures we've seen working their way through the economy, which includes housing prices and shelter costs rising along with wages. So interestingly, right, de-escalation could be a little more helpful to the Federal Reserve. And then the key thing to watch will be what happens to the labor market. As long as this labor market stays strong, the Federal Reserve still has room to raise rates. And so that may be the factor that really helps them. If confidence stabilizes, the labor market continues to improve, they may have more room to make up ground here on raising interest rates.
John, just very briefly here, when we think about retail investors, or any investor, quite frankly, that has positioned their portfolio with a mind towards globalization, this international conflict very clearly changes that calculus. And so where do investors who are looking across the global situation right now, where do they need to rotate? Where do they adjust? Where are you advising them to do so and kind of look across the assets that they're holding?
Yeah, so we came into 2022 saying you got to challenge conventional wisdom, and high yield as an asset class was actually less riskier than traditional investment grade because it's shorter in terms of duration. And really, I mean, as we continue to see this year play out, I think we're going to move to more of a bifurcated, multiple global supply chains instead of one supply chain, and that's going to be inflationary in nature. And then we see which developed markets are really positioned for long-term strength. And I think the U.S. continues to be the best house on the block. And, so we would favor domestic corporate exposure, particularly in U.S. high yield, because these companies are levered to the U.S. consumer, and the U.S. economy is in a much better position than Europe, China, and the rest of Asia is.
A big thank you to our panel breaking all that down for us. John McClain there, Portfolio Manager at Brandywine Global, and Rob Haworth, US Bank's Wealth Management Senior Investment Strategist. Thank you, gentlemen.